In this free video course, you will learn everything you need to know about technical analysis for trading stocks, crypto, forex, or any other financial market. By the end of this course, you will not only be able to use technical analysis correctly, but you will also learn about the multiple technical analysis techniques that most traders don't know about. Alright, so hello guys and welcome to this technical analysis masterclass. This right here will be a full course, so it will be a pretty long video from beginner to advanced. So make sure guys to really lock in, get comfortable, get your coffee, maybe you want a pen and paper, because this will be a pretty long video, but I have tried my very best to pack it with as much value as possible, so I don't want to waste any time. What I also can just mention super quickly before we get started here is that I have built this course in a sort of step-by-step manner. So I do highly recommend that you watch the chapters in order, but if you want to skip through the video, perhaps just watch some chapters and then jump back to chapters, don't worry, because I have created, a YouTube video chapter so you can clearly see what each section is about. But now let's get started. Alright guys, so before we can start using technical analysis to make money, whether you are trading crypto, stocks or forex, we need to of course know what is technical analysis in the first place. And in very simple terms, technical analysis is the study of price and volume. So technical traders look at price charts like candlestick charts and volume to forecast or predict market direction. And one important piece of information you already need to know is that charts basically show the collective actions of all market participants. Market participants are people like me and you, but there's also, smart money traders like banks and hedge funds and other financial institutions. All of our actions together is what creates the market. It is what creates these movements towards the upside and downside. And the goal here with technical analysis is not to, 100% predict that the market has to go up. It's all about probabilities. If you can find high probability setups, so let's say that you find a kind of pattern that succeeds 70% of the time with a 1-to-1 risk to reward. Don't worry if you have no idea what risk to reward is, you will learn all about it in this video. But if you have a 70% chance of, let's say, winning $100 and a 30% chance of losing $100, that's a trade you always want to take, because if you take enough of these trades, you will make money. And who uses technical analysis? Well, we have day traders. They, tend to get in and out of the market during the same day. We have swing traders that might, be in a trade from anything from like a few days to maybe a few weeks. And we also actually see long-term investors sometimes using technical analysis to find, even better entries and exits. Alright, so let's right away take a look at something that I think all of you guys watching this video want to know, and that is how to make money, and more specifically, how do we make money in financial markets. And in very simple terms, there are basically two ways we can make money in financial markets. First of all, we have investing. I would say that this is by far the most common way to, make money in financial markets. Investing is when you buy something to hold for a long time. I would say that if you plan to hold, over a few months, I would consider that as investing. And there are many different types to, do investing. You can use something called fundamental analysis. You can be very passive and, invest in, for example, ETFs and index fund. But don't really worry about this, because this video will be focused on the other way to make money in financial markets, and that is trading. And as I already mentioned, there are many different ways to trade. You can day trade, and that is when you get in and out of the market during the same day. You can swing trade, and so on and so on. But now I want to take a look at, how can we make money trading? Well, there are a few techniques, and the by far most common technique here is technical analysis, or for short TA. So when you see TA, this is the short for technical analysis. I will use this throughout the rest of the course. But when it comes to trading, technical analysis is not the only method. Some traders, trade using, for example, news or other events. They can use things like, different kinds of economic data to trade as well. So what I show you guys with this slide is that financial markets is a broad topic, and we have trading and investing, but technical analysis right here is the by far most common way to make money trading, and that is what this course is going to be all about. But right, so now the very first thing you need to learn about in order to master technical analysis and as a result make money is to learn how to read candlesticks and how to read candlestick charts. Why do you need to do this? Well, pretty much all traders, or at least most traders, used something called candlestick charts. It's a chart like you can see right here on the screen. So being able to read these charts correctly is something you cannot do without as a trader. So let's quickly take a look at how to read these candlestick charts. First of all, what you need to know is that we have two different kinds of candles. We have a green candle, which is also known as a bullish candle. And we also have a red candle, which is known as a bearish candle. And what you need to know here is that for the green candle, what this means is that the price has been going up during this period. And for the red candle, it means the opposite. It means that the price have been going down during this period. And now the question you of course ask is, what is the period? And here it will differ depending on what type of trader you are. So if you are a day trader, you might, for example, use 15-minute candles. That means that every candlestick represents 15 minutes. So if this green candle, let's say that the candle starts at 11, and if we use a 15-minute candle, it means that the candle ends here at 11:15. But we also have different kinds of candles. A candle can be, 1 hour, it can be 1 day, and so on and so on. But now, to make it simple, let's just think about that these candles are 15 minutes. So for the green candle, the candle starts right here, and this is known as the open. So the candle starts down here, and during the candle, it pushes up all the way up here. This is known as the close. So during the candle, the price goes from the open to the close. But you can also see that we have two more points here. We have something down here, which is called the low. This means that during this candle, even though that the price pushed up, it actually during this 15 minutes, the price pushed down all the way down to this point before going up. And as you might have guessed, the other point right here is simply called the high. And that means that during this 15 minutes, the price actually managed to push up here, but then it closed right there. And the opposite is of course true for the red candle. During this candle, the price pushed down. The price started right here. We can just write an O for open. It ended down here. We can write a C for close. And we have a low down here. So this was the lowest point the price reached. And we have a high up here. And to make this much more clear, let me actually show you guys how the price could have moved in this green candle. So let me actually delete some stuff so you can see it very clearly. We don't need this. So for example, this green candle started, remember the open is right here. So it started right here. But during the candle, the price pushed down to a lowest point down here. So it might have moved something like this. Then it pushed up to a highest point all the way up here. And then it closed down here. So this is one way how the price could have moved during this green candle. But it doesn't have to move this way. It could have, for example, open up here. It opens at the same level. But all we know is that the lowest point is down there. So the price maybe started by moving up, then moved down and hit the low. Then it might have moved something like this, up here, up there, and then closed down there. So this is another way how the price could have looked like. All we have here are the 4 data points. And to become a master in technical analysis, this is something you need to have in mind. But right, okay, so now I already want to jump into one of the most important things to learn in technical analysis, and that is something called market structure. And in very, very simple terms, market structure is market structure is basically what most people think about when they think about technical analysis. Market structure is the big picture framework of price movement over time. So when you look at a candlestick chart, what you're actually seeing on the chart is market structure. And don't worry if this sounds complicated right now, because you will learn it very quickly. So here, when it comes to market structure, we in general have 3 different states the market can be in. The first state is an uptrend, and this is where the price creates both higher highs and higher lows. Very soon we will jump into the drawings and I will show you this very clearly. You know, how exactly do we find an uptrend and how exactly do we find a downtrend? Because downtrend is the second state, and this is when we print both lower highs and lower lows. The third state we have here is what is known as a trading range. It also have different names. Some people call it a consolidation. These words can mean slightly different things here, but if you hear range, if you hear consolidation, you might even hear something like a sideways market. All of these things mean basically the same thing, and it means that the price is trading sideways between a support and resistance. And support and resistance is also a very important topic that you will learn more about throughout this course. But what you can think about is that you can think about it, market structure, as the sort of map of the battlefield between the bulls. Remember, the bull, when we're talking about something that is bullish or bulls, we're talking about the price going up. And when we're talking about something that is bearish, we're talking about the price going down. So you can think about the market structure as the fight here between the bulls and the bears. And it's before we zoom into something called price action. Price action is the next thing all traders need to know about, and we will talk about that later on in this course. But right, so now let's take a closer look at the basics of market structure. And remember, the market can be in 3 states. But how do we know exactly what state we are in right now? Well, the basics are like this. If we have, let's say that this right here is the price movement, as long as this price is creating both, this right here is what we call a low, and this right here is what we call a high. As long as the price are printing both higher lows and higher highs, so we can call this just for short a high and this for short a low, we are in an uptrend. So this right here is an uptrend. But then let's say that the price starts moving like this. You can see the price now fails to create a higher high, and maybe the low are right here. Maybe the price start going something like this. Right here, we are still printing a higher high, but you can see here, we are printing a lower high, or for short, LH. Here we're printing a higher low, but here we're actually printing a lower low. And here we're actually once again printing a higher high. This kind of market, when we have a mix between, lows and highs, and the lows and highs are at, the around same level, right? This right here is what is known as a range or sideways market. But next up, we have the downtrend. And remember here, in order to have a downtrend, we need to have both. Let me actually move my camera a bit here so you can see. In order to have a downtrend, we need to have both lower lows and lower highs. So here we have a high. Right here, we print a lower high. And this downtrend is not confirmed until we see this lower low. Now when we have both lower highs and lower lows, we are in a downtrend. But alright, so now then, it's relatively easy to just say, in order to have an uptrend, we need higher highs and higher lows. In order to have a downtrend, we need to have, lower lows and lower highs. But in order to really be able to do this in real markets, we need to learn about 2 concepts. And that is break of structure, or for short, BOS, and change of character, or for short, CHoCH. And make sure to really pay attention now, because this is so important. So let's say that we have a market that looks something like this, and then the price might move maybe down like this and something like this. And let's begin here by taking a look at what a break of structure is. So in very simple terms, a break of structure, or for short, BOS, is when we break to a higher high in an uptrend or to a lower low in a downtrend. So if you take a look at this price right here, you can see that at this point, the price pushes above the previous high. Remember, the high is right here. So this is actually a break of structure. And what a break of structure basically tells us is that the trend is continuing. Once again, right here, if we look closely, we can see that this is the point where the price breaks above this high right here. So this right here is another break of structure, or BOS. But you can see that the next time we print another high right here, but you can see that the next push, this push right here, actually fails to push above this high. And because of this, it's not a break of structure. Instead, what we need to learn about now is what a change of character is. And a change of character is when we break below a low or high that caused a break of structure. So pay very close attention to this chart right here. Which was the last low that caused a break of structure? Well, right here, you can see that we have a low that caused a break of structure, because this is the point where the price pushed above the last high. So this was a low that caused a break of structure. Another low that caused a break of structure was right here. But if you take a look at this low did not cause a break of structure because it didn't push above this point right here. So in other words, the last low that caused a break of structure was this low right here. And you can see that when the price broke below this point right here, this is where we find a change of character. And here, different traders use slightly different methods, but what I'm considering here is that this right here was the most recent significant high. So I see this high right here not necessarily as an important high, because this high right here wasn't a higher high. If we are very technical here, we can talk about that this is actually what we call a minor structure. So this might be a significant level if we zoom in to the shorter term time frames. Don't worry, we will talk about that more. But what I'm considering is that this right here is the main high. And it's not until the change of character right here that we create our first low. Then you can see right here, we have a lower high, right? And remember what a break of structure is. That is when we break to a higher high in an uptrend or to a lower low in a downtrend. So this break, when the price pushes below right here, is a break of structure. And when we see this break of structure, we have a lower low right here. So we have one high, we have a lower high, we have one low, we have a lower low. So right here, we have confirmed the downtrend. So just to repeat here and really lock this in, a break of structure, or for short BOS, is when the price pushes past the last swing high or low, depending on if we are an uptrend or downtrend, and this confirms that the trend continues. A change of character is when the price breaks against the trade, as I showed you guys earlier, and this is a clue of a reversal. But remember, the true reversal is not confirmed until we either have, two higher highs and higher lows, or two lower highs and two lower lows. So as a general rule of thumb, you can think about break of structures as trend strength and change of characters as trend weakness. And these will help you decide, should I stay in the trend or should I start preparing for a reversal? So now the next concept every technical trader really needs to know about is something called price action. And price action is basically studying how the price is moving right now. So how is the current candle we're looking at moving right now? So we're looking at it as a sort of candle by candle basis. So for example, and I will show you guys this later on, if we are at, for example, a support level, how does the price move at the support? Does it bounce sharply? Does it maybe, stall sideways at the support? Or do we even break through? In general, we think about fast moves as, urgency. We talk about grinding moves as hesitation. And I think about price action as the character of the movement, not how the price has moved in the past. That is market structure. Price action is the character of the movement right now. So let's say that we have, a price that moves up and down like this. All of what you can see right here is simply just market structure. But then you might wonder, what is the actual price action? Well, price action is how my hand is moving right now when I'm drawing. Am I drawing, for example, slowly like this, or am I drawing, violent like this? Think about market structure as the trace we look at in the past, and price action, how the price is moving right now. So as a simple example, let's say that we have a support level right here. So this right here is a support. If you don't know what a support level is basically a level where the price has bounced in the past. So maybe the price have looked something like this. You can see right here we have 1 and 2 clear touches on the support. This means that we have a support level, and it's very possible that because we have seen bounces in the past, the price might bounce here in the future. And to make this very clear, let me actually draw another support level, and let's say that the price action was the exact same. We had 2 bounces right here. But now then, when we talk about price action, we're talking about, how the price reacts to, for example, when we reach the support. So let's say that in one case, when we reached the support, we had a red candle like right here, but then we saw a sharp green candle right here. By the way, these candles together is what we call a candlestick pattern, and I will talk about candlestick patterns later on in this course. But in the first scenario, we saw price action like this. But let's say that in the second scenario, we maybe had the first red candle similar like the previous one, but maybe instead of a, sharp green candle, the next red candle might have looked something like this. So right here is exactly what we mean by price action. In this case, we had, an aggressive price action. We saw lots of bulls. Remember, when we talk about bullish, we're talking about, moves to the upside. We can see a sharp move towards the upside, and that actually indicates that this support might be holding. It might even be enough to, take a trade right here, because we saw, lots of buying pressure coming in at the support. But in the other scenario, while the market structure is exactly the same, we can see very different price action, because in this other scenario, we saw hesitation. So while in scenario 1, you might have enough information to actually take a trade and go long. Going long means that you're betting that the price will go up. But in the other scenario where we see hesitation, let me actually move my cam so you can see. In the other scenario where we see hesitation, this might not be enough information to take a trade. You might want to wait, or maybe this might be enough information to confirm that the support is weak, and maybe you want to go short and bet that the price will go down. Another example could be something like this. As you can see, we clearly have 2 uptrends right here. So what we as traders are looking out for right now is, will we see a break of structure or not? You can see the price is right now testing, if we will print a break of structure or not in both of these scenarios. And let's say that in one case, when we reach this level, we see a massive green candle. Indicates that the bulls are in full control, and that they are really, it really looks like they are pushing above the level and confirming the break of structure. But in the other scenario, maybe the price here starts by pushing up, but during the candle, the bears take control, and maybe we see a candle that looks something like this. This, by the way, is what is known as a shooting star candle, and that is a bearish candlestick. So even though the market structure here are the same in both scenarios, scenario 1 here indicates that it's likely that the trend will continue to the upside, while scenario 2 here indicates that we very, well might see a reversal to the downside. And this is why price action is so important. But right, so now let's take a look at our first real example. Right now we are in TradingView. TradingView is the platform I use for all my technical analysis, even for all my sort of investing analysis as well. And by the way, guys, if you don't have TradingView yet, I do have a special link to TradingView. You can use that link to try out TradingView Premium for free for 30 days. And if you, after the trial, decide that you want to continue, you will get a $15 bonus toward your new plan. But now, let's take a look at this chart right here. The first thing I want you guys to notice is, are we in an uptrend or downtrend? Well, let's sort of mark this chart up, we can see that we have a push up right here, the price pulls back, we have another push up right here, the price pulls back, we have another push up right here. So you can see that we are printing, you know, both. We have a low, we have a higher low, we have a high, we have a higher high. So here we are in an uptrend. I also want you to be able to identify the break of structures and potentially change of characters. If you take a look at this point right here, when the price broke above, is this a break of structure or change of character? Well, this right here is clearly a break of structure because the price pushed above the previous high. The next thing I want you guys to notice is, you know, how was the price action when we broke above this high? Well, if you take a close look, you can see that this green candle right here was the candle that broke above the previous high. So when we talk about the price action of this candle, we can actually see that we saw some very strong movements. The bulls were aggressive and they even closed the candle. Remember the candle close, they even closed the candle far, far above the previous high. So this right here is price action that indicates that the trend will continue. And after this move, you can see that the trend indeed continue here. We printed a new high and we even continued a bit higher. But right, so now I want to switch the attention a little bit and take a look at some of the most important candlestick signals you really need to learn. And the first signal I want to talk about is a signal called a hammer. A hammer is a specific candlestick that appears after a move toward the downside. So it's very important that in order to have a real hammer, we need to first see a move towards the downside. And the candle itself is a candle with a small real body. The wide part of the candle is what is known as the real body. And a hammer should also have a long lower wick. And what is important here, so let me just write it down right here. So this right here is what is known as the body. This part right here is what is known as the wick. And what is important about the hammer is that the wick should be at least twice the size of the real body. So you can see that in this case, the wick is maybe, you know, 3 times or even 4 times as large as the real body. And this means that we have a hammer. And as for the color of the hammer, we, you know, preferably want the color here to be green, but it can even be red. It doesn't matter if it's red or green. If you see this shape, this right here is a valid hammer. And this particular candlestick pattern indicates a reversal to the upside. And just as with anything in trading, it gets stronger if we combine it with other things. So for example, let's say that we have a support level right here and the hammer comes in at the support. This makes the hammer much more likely to succeed. And other things like, you know, general price action principles, so, you know, how has the support looked like in the past, can also make that hammer, you know, stronger or weaker. But this right here is the first candlestick signal you really need to learn. The second candlestick signal you need to learn about is the shooting star. And if you learn the hammer, this one will be very easy to learn because it's the exact opposite of a hammer. So a shooting star is the bearish version of a hammer and it needs to appear after an uptrend. So we see an uptrend and then we see a candle that looks something like this appear. It can also have a little bit of a lower wick, but this wick right here should preferably be small. Just as before, the color of the real body is not super important, but it's a little bit more bearish and a little bit better if this one is, you know, red. And also if the shooting star appears here at a key resistance, the signal gets stronger. And once again, the wick should be, you know, at least twice the size of the real body. And this is what is known as a bearish reversal pattern. So after this pattern appear, the odds are that the price will reverse to the downside. But it's very important to really think about everything in odds. Just because you see a shooting star appear, it doesn't mean that the price will 100% reverse. This is just one piece of the puzzle indicating that the price is likely to reverse. The next candlestick signal you really need to learn about is called the Doji candle. And a Doji candle is very simple to learn. A Doji candle is a candlestick that has a very small or no real body at all. So if you see a candle that maybe looks something like this right here is a doji. If we have a candle that maybe looks, you know, has a little bit larger real body but still has long upper and lower wicks, this right here is what is known as a spinning top. And dojis and spinning tops can look in many different ways. So you might have a doji that maybe looks something like this. You might have a doji that looks something like this. You might have a spinning top that maybe, you know, has a long lower wick. You might have, you know, a doji that maybe looks something like this, right? But the common denominator of all of these dojis is that the real body is very small. And you might wonder, what does these candles tell us about the price? Well, all of these candles indicates something called indecision, which means that neither the bulls or the bears are in full control of the market. So when you see these kind of candles, it means that we pretty much have a tug of war between the bears and the bulls, and that we don't really have a strong direction. And as with all candles, it's important where they appear. So let's say we have an uptrend right here. The price is trying to create this, you know, break of structure and push further, but maybe on this break of structure level we start to see, maybe some doji candles and maybe some spinning tops. It's a little bit ugly writing here, but I hope you get the point. When we reach these points, we start to see hesitation, and this can actually indicate that maybe the bulls aren't strong enough to really push this trend further, and this might be a clue that the price might actually reverse to the downside, or at least that the price might be entering what? Well, a sideways market. Remember, only because we're seeing bearish signals doesn't mean that the price will immediately reverse from an uptrend to downtrend. It can simply mean that the price will reverse from an uptrend to a sideways market, right? Always have the three markets, uptrend, downtrend, and sideways market in mind when you're trading. Alright, so the next pattern you really need to learn about, and this right here is one of my personal favorites because it appears so often in the market and the signals can be really strong, and that is the engulfing patterns. And when it comes to engulfing patterns, we have two different kinds. We have a bullish version and we also have a bearish version. And just as with the hammer pattern and shooting star, these two patterns are reversal patterns. So for the bullish version, before the pattern appears, we need to see a move towards the downside. And the actual pattern, when it comes to the engulfing pattern, consists of two candles. And here, the color is actually important. So for the bullish engulfing, we want the first candle to be a red candle, and preferably we want the real body to be, relatively small. The second candle in the bullish engulfing should be a green one. And here, and this is very important, the real body of the green candle needs to engulf the real body of the red candle. So what do I mean by this? Well, the green candle needs to open below and close above this part right here of the red candle. Remember, this is what we call the body of the candle, and the bullish engulfing need to open below and close above. In some markets like crypto, where we don't really see gaps, it is okay for the green candle to open at the same level as where the red candle closes. The most important part is that we see a candle close. So this close right here needs to be preferably pretty far above the open of the red candle. And after you have seen these two candles, the pattern is confirmed, and the goal of the bullish engulfing is to reverse the price towards the upside. And as with all other patterns, it's very important to consider the market structure. So for example, if a bullish engulfing pattern appears at a key support, that is a very good sign. As for the bearish engulfing pattern, this is the exact same thing, but the opposite. Before a bearish engulfing pattern appears, we need to see a move towards the upside. For the bearish engulfing, the first candle should be a green one and preferably a relatively small candle. And the second candle should be a red one. And in this case, I can show you the scenario where the red candle opens here at the same level as the close, but then it pushes the price down here and it clearly engulfs the green candle. So you can see the real body of the green candle here is completely within the body of the red candle. And we can have, it's okay to have some wicks. It doesn't really matter too much for the engulfing, as long as we see this, red candle really engulf the previous real body. And after the bearish engulfing pattern appears, the goal here is to reverse the price to the downside. And as always, the market structure in where these patterns appear is super important. Alright, so now let's actually jump back here into TradingView because I want to show you guys an example. Right now we're looking here at NVIDIA and we are on a daily time frame, meaning that every candlestick on this chart represents one day. But you can use candlestick patterns and candlestick signals if you're day trading. You might be using 5-minute candles, 15-minute candles, and so on and so on. But on this chart, every candlestick is one day. And what I want to show you guys right here is, first of all, that we can see a pretty clear support level on this chart. You can see that right here, we had a low. We had a low at the around same level here, a low at the around same level here, and also a low at the around same level here. And so what we can do here is in TradingView, we can use geometric shapes and we can go down here and use the rectangle. When I draw my support and resistance levels, I prefer to, draw out zones rather than to draw out lines, because in real markets, the support and resistance levels will pretty much never be these perfect lines. You should see them more of as, zones. And here I just want to show you guys some examples of candlestick patterns. First of all, I want you guys to take a close look at this pattern right here. You can see we had a move towards the downside. Then we saw a relatively small red candle, right? And as you can see, the next candle right here was a massive, massive green one. And even more importantly, you can see that the real body of the green candle clearly engulfs not only this red candle right here, but it actually also engulfed the green candle. So here we had a very strong bullish engulfing, and after this, the price reversed towards the upside. As just a trading example, in TradingView you can go to this right here where it says forecasting and measurement tool, and the long position right here means that you bet that the market will go up. So one way to trade bullish engulfing patterns is to enter here at the candle close. You place the stop loss just below either the lowest point of the green candle or even below the support zone, and then using a risk to reward ratio of 1.5, your trade would have looked something like this. And now if you look closely, you can actually see that we had the opposite pattern appearing right here. The first candle in this pattern is a doji, and you know what a doji candle is, and the next one is a strong red candle. So as long as this red candle engulfs the real body of the doji, we actually have a sort of valid bearish engulfing. And you can see that after that pattern, the price fell sharply here towards the downside. Another pattern you can see right here, this one probably is familiar for you guys as well. This right here is actually a hammer candle. And this is a very important example of price action. You can see that during this candle, the price actually pushed below these supports. So this is a warning sign that this support might be breaking and we might see a move towards the downside. But before the candle closed, the bulls managed to push the price all the way up here. So we managed to push the price, above the support once again. And not only that, because we also printed a bullish hammer. And when a bullish hammer comes after a move towards the downside, especially when it comes in at a support level, that is a bullish reversal signal indicating a move towards the upside. So here I have showed you guys, an example of a bullish engulfing, a bearish engulfing, as well as a bullish hammer. And as I have been, talking about throughout this course, they are much better the more sort of signals we combine. So in this case, we combined a hammer with a, support level, but during the course, you will learn about many more things that you can include in your analysis to make it more likely to succeed and make you more likely to make money. But alright, so now let's just do some quick repetition so you can really lock these candlestick signals in. The first candle we have learned about was the doji candle, and it indicates indecision, that sort of buyers and sellers are in balance. Remember, we are thinking about it as a tug of war between the bulls and the bears, indicating that neither of them are in full control. Another pattern that I really like is the hammer pattern. We have a long lower wick. We are rejecting lows, and it's a bullish signal, especially if it comes in at support. The shooting star is the opposite. We have a long upper wick and we are rejecting highs. And it's especially bearish if it comes at resistance. The bullish engulfing patterns is one of my personal favorite. And to be honest, all of these patterns, a big reason I include them in this video is, first of all, because they appear very often in the market and they are also very useful. And I really like the engulfing patterns. As I said, it's one candle that fully covers the previous candle and it indicates a shift in momentum. And last but not least, for all of these patterns, they are stronger when they form at key support and resistance levels. But alright, so the next thing I do want to cover, and this is something that beginners usually, are super interested in, and that is indicators. But what are indicators in the first place? Well, indicators in very simple terms are just math applied to price and volume, and this can make the chart easier to read. The reason you're using indicators is to make the chart easier to read, and that is very important to have in mind. If you use indicators and it makes the price harder to read, you're using the indicators wrong. But here are some examples. We have moving averages. This is a very popular indicator that shows sort of trend direction, and you can use them as dynamic support and resistance. By dynamic support and resistance, I mean that the support and resistance changes over time. This is different compared to the normal horizontal support and resistance levels we have used so far. But in my opinion, I'm not really a super big fan of moving averages. I know lots of traders are and they use them successfully, but some indicators I really like more are the RSI, the MACD, and the volume indicator. The RSI and MACD are pretty similar. They both measure something called momentum, and that is basically the character of the price movement. So how fast and how violent are the price movements. So when it comes to the RSI, you can measure something called overbought and oversold zones, and you can also use something called momentum divergence. The MACD also measures momentum shift and trend quality. And you can also use divergences on the MACD. I will soon show you guys this. Last but not least, and this is a very important indicator, that is the volume indicator. And volume is, in very simple terms, how many stocks, cryptocurrencies, or even forex pairs that changed hand. So the more volume we have, the more people bought and sold during that candle, and the more people bought and sold, the more significant the move becomes. And one very important thing to have in mind about indicators is that you should use them as confirmation tools and not as crystal balls. You should always, at least in my opinion, you should always consider the market structure and price action first, and then you can use an indicator to make the trade even more likely to succeed. But alright, so now let's actually once again jump back into TradingView. This is the same chart as we used before, and I can also remind you guys of my TradingView link. The special link will give you TradingView Premium for free for 30 days, and you will get a $15 bonus if you later on decide that you want to upgrade. But now let me actually open up one of my personal favorite indicators, and that is the RSI indicator. To find the RSI in TradingView, what you do here is that you go up here to the indicators tab and you press right there, and then you simply search for RSI. And as you can see, first of all, you have something called technicals right here, and this is sort of indicators that are built by TradingView. So these are indicators that are built by the platform, but you also have tons of different, variations of the RSI indicator that is actually built by the community. So these are built by, other traders. They might make some, change the RSI to make it better for some situations, and they might have different settings. Sometimes they include whole trading strategies, and this is one thing that I really like about TradingView, that it has probably the largest trading community, maybe even in the world. I actually think so. So you can use other people's strategies as well. But before you start using other people's strategies, it's very important to learn about the actual indicators. So now let's open up the normal RSI, which stands for Relative Strength Index. And now, as you can see, we have this RSI indicator popping up at the bottom of our screen. And first of all, what does the RSI measure? Well, as I mentioned earlier, it measures the momentum. So it measures how fast or how violent the price moves towards the upside. And if you take a very close look right here, you can see that right here, we have a strong spike in the RSI. You can see the value here is pretty much the highest value of this whole chart. And that means that we're seeing very strong bullish momentum. And why did this spike happen? Well, in this area, from this low all the way down there, here we saw something we called a gap. And this is where the price pretty much teleports from one price level, you can see right here, to another price level. And you might wonder, why did this happen? Well, if you go down here, you can actually see that NVIDIA had an earnings report. Let me remove the drawing. It had an earnings report where it made, very positive surprises. It had 18% more earnings than the estimate. It had 10% more revenue than the estimate. So it was a super good earnings report. And stocks don't trade during the night. An earnings report usually comes out after the market is open. So during this gap, the market got new information, which led to that when the market actually opened, it opened all the way up here. And because we saw such a big spike in move, it was pretty much a teleport in price. We saw this massive momentum on the RSI. And some basics of the RSI is that when it's above this line right here, the 70 line, we say that the price is overbought. And when it's below this line right here, we say that the price is oversold. A common mistake that beginners make is that they think that when the price is above 70, that means that we should sell. But as you can see in this case, the price just continued to push higher, even though the RSI was high. And this is actually, in my opinion, a really bad way to use the RSI. A better way to use the RSI is to look for something called divergence. And before I show you divergence, I want to make some changes to the RSI. I want to remove the RSI based moving average. I want to make the line here a bit more clear so you can see. And let's actually remove the background fill here. So you can see a very clear line here of the RSI. But now then, what is a momentum divergence? Well, in very simple terms, a momentum divergence is when the price goes in one direction. Like for example, right here, we have a low and we have a lower low. But at the same time, you can see that the RSI had a low right here and then it had a higher low. So you can see that the price goes in one direction, the momentum indicator goes in the opposite direction. This right here is what we call a bullish divergence, and it indicates a reversal to the upside. So now, hopefully you guys can start see how it all comes together. Here, we now have three things happening at the same time. We have, first of all, a support. That is the first thing. Second thing, we have a bullish price action coming in at the support. In this case, it was a hammer. So this is our second signal. Third signal, we had a divergence as well. So now we have three bullish signals happening at the same time. And this is many times enough to consider a trade. Now, to enter the trade, you click right here. You press your long position. And let's say that we entered at the candle close of this hammer. The normal way to set your stop loss is to set your stop loss just below the low of the hammer. And then using a risk to reward ratio, let's for example use a risk to reward ratio of 3. That is a very common risk to reward. Your trade would have looked like this and you would have locked in some nice profit. But right guys, now it's time to switch the attention and take a look at something called chart patterns. And in simple terms, chart patterns are larger formations that reflect the sort of trader psychology and the market structure. So we have already been talking about candlestick signals. These are signals that appears in maybe one candle up to max of like 4 or maybe 5 candles. Candlestick patterns and candlestick signals are pretty small, but chart patterns are larger sort of market structure signals in the market. And just as with candlestick patterns, they can be reversals, meaning that, before let's say we have a bullish reversal, that means that before the pattern, the price moves down, then the chart pattern appears, and the goal of the pattern is to reverse the price to the upside. And some examples of reversal chart patterns are head and shoulders, double top and double bottom, and as I said, it makes that the trend is likely to end. We also have something called continuation patterns. And what a continuation pattern is, that is when we have, let's say we have a bullish continuation pattern. That means that the price is moving up, then the pattern appears right here, and the goal of this pattern is to continue the price in the same direction. So reversal, the goal is to reverse the price. Continuation, the goal of the pattern is to continue the price. And one thing that is very good about chart patterns is that they give you clear structure. So for all chart patterns, you have clear rules where to set your entries, where to set your stop loss, and where to set your target. And one thing to always have in mind is that you do want to confirm the breakouts from these patterns with the volume indicator. But alright guys, so now I want to show you guys one of my personal favorite chart patterns, and this right here is what is known as a bull flag or bullish flag. And this right here is a continuation. It's a continuation pattern, and more importantly, you can hear it on the name, it's a bullish continuation. So the goal of this pattern is to continue the price towards the upside. So for a bull flag, before the bull flag appears, you want to see a move towards the upside. And then the actual flag looks something like this. You have this move, and then the price sort of creates a small downtrend after this up move. What we then do is that we draw a resistance level and a support level of the flag. And the goal of this flag here is to break to the upside. So if the price then bounces once again at the support and then breaks the flag, you can see this point right here is what we call a breakout. Let me move my camera a bit so you can see. This right here is what is known as a breakout, and this is a common place where traders tend to enter the market. But as with this whole course, always have the price action in mind. So in order to have a good breakout, I'm sorry, I accidentally deleted the whole pattern, but as I said, during the breakout, we want to see a strong bullish candle. This means that we have bullish price action on the breakout, and preferably we want to see lots of volume here. Don't worry, I will show you guys this very soon when we take a look at an example, but we want to see a strong green candle and we want to see lots of volume. This makes the pattern more likely to succeed. And guys, learning about chart patterns is a very, there are tons of chart patterns and there are rules for all different patterns. And we don't really have time to go through all patterns in this course. But luckily, I do have a full chart pattern trading course right here on YouTube. And I will make sure to link it up in the video card in the corner. You don't have to watch it right now, but make sure to, save it to a watch later playlist and check that one out after this course. Alright, so now let's once again jump back here into TradingView. Currently, we're actually looking at a silver chart just for some variation. As I said, you can use technical analysis to trade anything from crypto, forex, stocks, but you can also trade commodities like silver and gold and so on and so on. But right now we are here on a daily time frame. But I want you guys to take a close look at this chart right here. Can you identify any flags on the chart? Well, in real markets, it's usually very hard to identify. But if you look closely right here, you can definitely argue that we had a flag, right? Because before the flag appeared, we have a move towards the upside. Then we saw this consolidation where the price sort of cools down for a while and trades slightly downward. And then after this, you can see that we saw this strong green candle. Remember, price action is king. And we saw, after this green candle, we saw a nice move here towards the upside. And in order to draw out your flags in TradingView, what I usually do is that I use the trend line tool. You find the trend line by clicking right here, then trend line, and then you simply draw out a trend line like this. You can click Control C and then Control V to draw out your flag. But one more factor that, as I mentioned, that makes flags, more significant is if we have lots of volume on the breakout candle. So this right here is the breakout candle. So now let me show you guys how to find the volume indicator. To do that, you go up to the indicators tab and you simply search for volume. Let me remove the drawing right there. And as you can see, when it comes to volume, you have tons of built-in volume indicators, and you also have tons of community built indicators. But for this one, I'm just going to keep it super simple and use the normal volume. And then what you want to do is that you want to check the volume on the breakout candle. So we look at the green candle right here. We go down here to the volume bar. And by the way, the height of the bars determine how much volume we have. If you want to know the exact volume, you can hover over the bar and you will see the volume up right here in this corner right here. When it comes to commodities like silver and gold, the volume is not as exact as usually not as exact compared to when it comes to, for example, stocks and cryptocurrencies, but it's still definitely a very useful indicator, at least in my opinion. So you can see here that we had a bullish pattern, we had a bullish price action signal. So, you know, we can think about the pattern as the first bullish thing. The second bullish thing is that we have a strong breakout. The third bullish thing here is that we saw lots of volume. So here we have 3 bullish things happening at the same time. So this is enough for us to enter our long position. We enter here at the candle close. The stop loss is usually set, you know, either below the lowest point of the pattern, or if we can find some kind of low, you know, before the breakout, sometimes we set the stop loss below that. But in this case, we set the stop below the low of the pattern, and using a risk to reward ratio of 1.5, our trade would have looked like this. But right, so now I want to switch the attention to one of the most important things when it comes to trading and technical analysis. If you don't know this, you will not trade successfully, and that is risk management. If you don't manage your risk correctly, you might, you know, have a very good streak, maybe for weeks, maybe for months, but if you slip, you can actually delete months or sometimes even years of progress, you know, by losing it all on maybe one trade. So it's super important to have your risk management in check. And as you can see right here, this is the sort of the most important survival skill when it comes to trading, because it protects your capital, or in other words, it protects your money, so you can keep trading. And there are a few rules that are very good to use. One rule is to only risk around 1 to 2% of your account per trade. If you, for each trade, only risk 1 to 2%, you can lose, you know, 3 times in a row, 5 times in a row, or even more, and still have, you know, don't blow up your account. Another thing you really need to learn about is something called position sizing. And in simple terms, that is your account risk divided by the stop distance. And in this course, we don't really have time to dive super deep into risk management, but don't worry, because I do have a full guide on risk management right here on YouTube. So make sure to check that one out when you have the time. Save it for a watch later playlist or something like that. Another thing that this is not something you have to do, but a very common thing to do is that to aim for a reward at least 2 to 3 times bigger than the risk. And this is where the concept of risk to reward comes in. It's called risk reward, or for short, RR. So let's actually jump back here into TradingView so I can quickly show you guys what risk to reward mean. And to do this, we're once again gonna open up a long position right here. And I'm just gonna press it right here on the chart. So you can see, when we just open up the long position, the standard here, you can see that on this bar right here, it says risk to reward ratio 1. And what this means is that we have the distance here of the reward is the exact same distance as the distance of your stop loss. And by the way, when the price reaches the top here of the reward bar, this is where you lock in profit. And if the price goes below this point right here, which is your stop loss, this is where you automatically sell your position. So a risk to reward ratio of 1 means that we win as much as we lose. But as I mentioned earlier, a more common risk to reward is to have your stop loss maybe something like this. Now you can see that it changes to a risk to reward ratio of 3. But now, what does it mean when we have a risk to reward ratio of 3? Well, here you can see that the distance down to your stop loss, where you automatically sell, is only a third of the distance up to your profit target. And when you have this kind of risk to reward, it actually means that you only need to win, in theory at least, 25%, or you need to win more than 25% of your wins in order to make money. And this is if we don't count with all the, you know, fees and potential slippage and every other risk like that. But you only need to win, you know, in theory, more than 1/4 of the time. And some of the most common risk rewards is to either use a risk reward of 3 or a risk reward of 2. But what I do want to point out is that you can actually win with, risk rewards of maybe 0.5 and stuff like that as well. It's all about, you need to combine how often you win with the risk reward. Another good rule of thumb is to try to cut your losers quickly and let winners breed, meaning that if we can let our winners run, we can make, lots of money, but we do want to try to limit the risk, as fast as possible. This is not something you have to do, but this is a general good rule of thumb. And here, this is a key rule, discipline is so important in trading. You really need to stick to your rules. It doesn't matter if you have a risk reward of 2 or a risk reward of 3. The most important part is that you stick to your trading plan. But alright, so last but not least, let's try to put this all together, what we have gathered from this course. And step number 1 here is to define the trend and define the overall market structure. In this video, we only briefly touched on market structure and there are tons of more to learn. But luckily, I do have a full course on market structure. I will make sure to link it up in the corner in the eye so you can, go through that whole course after this video. Step number 2 here is that we do want to mark up our key support and resistance. And this is actually a part of market structure. But if you want to learn more specifically about support and resistance, I do have a full course about that as well. And I will make sure to link it up in the video card. Step 3 here is that we want to look at the price action. Price action, as I said, in my opinion, price action and market structure are the 2 most important parts of trading. And for price action, I also have a full course. Step 4 here is to use indicators or volume. I should actually say and volume here, and volume for extra confirmation. This can make the probability of a successful trade much more likely. And if you want to learn about indicators, I do have full courses on that as well. Last but not least, risk management is key. You want to learn about things like size, position, stop loss and target level, and how to manage your trade. Trading is all about the probabilities of your trade succeeding, having a good risk control, and last but definitely not least, to be consistent and disciplined. But alright guys, so this was a long course, but we are only scratching the surface of technical analysis. So when you have the time, I highly recommend to check out this playlist. Here you will find all the trading courses you need to master technical analysis.